Now we move into asset replacement decisions. Businesses often must decide whether to keep existing equipment or replace it with newer equipment. Fixed assets can become worn, obsolete, or costly to operate. In such cases, businesses must decide if it's economical to continue using the asset or replace it with a new one. The key concept here is that the book value of the old asset is a sunk cost. Sunk costs are irrelevant. The relevant factors include the cost of new equipment, proceeds from selling old equipment, changes in annual operating costs, changes in annual revenues, and residual value of the new equipment. Let's examine MC Aero's decision to replace an aircraft. MC Aero is considering replacing its Cessna 414 Chancellor airplane with a new 414A Super Chancellor. Let's evaluate the facts. First, the selling price of the current plane that they currently own, the 414, is $400,000. The purchase price of the new 414A Super Chancellor is $1 million. The incremental annual revenue increase from replacing the 414 with the new 414A is $50,000, and the annual variable cost savings is $20,000. Let's review the relevant data. The relevant data includes the book value of the current 414A, which is $250,000. That's a sunk cost, so of course it is not relevant. But the selling price of the current 414A of $400,000 is relevant, along with the annual revenues and cost differences between the 414 and 414A models. Now let's compute and compare the outcomes if MC Aero decides to retain the current 414 or purchase the new 414A. You can see that the annual revenue increases by $50,000, the variable cost decreased by $20,000, so annual contribution increases by $70,000 if they purchase the new 414A. That results in an increase of profits of $700,000 over the 10-year period. However, the cost of the new plane is $1 million. Now we're at a loss of $300,000. But the sale of the new 414A at the end of its 10-year useful life would yield $200,000 in residual value, and selling the current 414A would also yield $400,000. So taken all together, the total net effect of purchasing the new 414A would be an increase in profits of $300,000. Now complete learning activities 7-8. Van Wilder is deciding whether to replace an old welder. You are given old welder selling price and annual operating costs, and new welder purchase price, residual value, and annual operating costs. Remember, the book value of the old welder is irrelevant. Your job is to compute the net effect on profit if Van Wilder replaces the welder. Pause here and work through the activity. Once you've finished, check your answers with the solutions provided in the back of Chapter 7.